With every modern-day financial scandal that occurs, questions arose about the damages and the methods applied by master con artists to sustain their fraudulent investments program. Their attempts to defraud a person or group after first gaining their trust. But there's one question when answered, it mainly answers all the questions above. That question is, what's a Ponzi scheme? We've all heard that financial-related term at least once in our life, and for most of us who bother to search the term in the internet, most results show a man under the name of Charles Ponzi. In fact, today's subject isn't about Charles Ponzi. It's about the scheme itself that was named after Charles for some reason. Even though some of the first recorded incidents to meet the modern definition of a Ponzi scheme were carried in 1869, 13 years before Charles was born. So back to our question, what's a Ponzi scheme? A Ponzi scheme is basically a fraudulent investments program that involves using payments collected from new investors to pay off the earlier investors. The organizers of Ponzi schemes usually promise to invest the money they collect to generate supernormal profits with little to no risk. However, in the real sense, the fraudsters don't really plan to invest the money. Their intention is to pay off the earliest investors to make the scheme look believable. As such, a Ponzi scheme requires a constant flow of funds to sustain itself. When the organizers can no longer recruit more members or when a vast proportion of the existing investors decide to cash out, the scheme tumbles. They use vague verbal guises such as hedge futures trading, high-yield investment programs, or offshore investment to describe their income strategy. It is common for the operator to take advantage of a lack of investor knowledge or competence, or sometimes claim to use a proprietary, secret investment strategy to avoid giving information about the scheme. The basic premise of a Ponzi scheme is to rob Peter to pay Paul. Initially, the operator pays high returns to attract investors and entice current investors to invest more money. And when other investors begin to participate, a cascade effect begins. The schemer pays a return to initial investors from the investments of new participants, rather than from genuine profits. Often, high returns encourage investors to leave their money in the scheme, so that the operator does not actually have to pay very much to investors. The operator simply sends statements showing how much they have earned, which maintains the deception that the scheme is an investment with high returns. Investors within a Ponzi scheme may even face difficulties when trying to get their money out of the investment. Operators also try to minimize withdrawals by offering new plans to investors where money cannot be withdrawn for a certain period of time in exchange for higher returns. The operator sees new cash flows as investors cannot transfer money. If a few investors do wish to withdraw their money in accordance with the terms allowed, their requests are usually promptly processed, which gives the illusion to other investors that the fund is solvent and financially sound. Ponzi schemes sometimes begin as legitimate investment vehicles, such as hedge funds that can easily degenerate into a Ponzi-type scheme if they unexpectedly lose money or fail to legitimately earn the returns expected. The operators fabricate false returns or produce fraudulent audit reports instead of admitting their failure to meet expectations, and the operation is then considered a Ponzi scheme. Here are 3 warning signs and red flags for you to run from the investment if it includes extraordinarily high guaranteed returns. Ponzi schemes usually offer abnormally high guaranteed returns of more than 20% per annum, or even more ridiculous, per month. The attractive returns are used to lure investors to invest in their products. However, there is no such a thing as guaranteed returns in this world. Even the money in your savings account can disappear if the bank goes bust, because there is always some degree of risk to every investment. If you think about it, if a company is able to promise investors 20% returns per annum, this means that they have to generate returns higher than 20% in order for them to turn a profit. And if this company is able to generate annual returns above 20% consistently, the owner of the company should already be one of the richest men on the Forbes list. For context, Warren Buffett's annual return over the last 51 years, from 1965 till 2016, is 20.8%, and he's arguably the world's greatest investor. So always be skeptical when schemes offer you abnormally high and consistent guaranteed returns. Overly consistent returns. It's basically when investment values tend to go up and down over time, especially those offering potentially high returns. An investment that continues to generate regular positive returns regardless of overall market conditions is considered suspicious. unlicensed sellers. Federal and state securities laws require that investment professionals and their firms be licensed or registered. Most Ponzi schemes involve unlicensed individuals or unregistered firms, the few exceptions usually being the aforementioned investment vehicles that started out as legitimate operations but failed to earn the expected returns. With that being said, we made it to the end of the video. Thank you for watching, and if you liked the video, make sure to subscribe and hit that bell to turn on notifications for more interesting stories about finance. I'll see you in the next video. Take care.